Now, you've mentioned this before, but I want to go deeper on the idea that equipment financing isn't one size fits all. Different industries have different needs, different challenges, and different types of equipment.
Absolutely. What works for a tech startup might not work for a construction company, for example.
Right. I'd love to hear your thoughts on some specific industries. Let's start with manufacturing. They rely on expensive, specialized equipment, and that equipment can become outdated pretty quickly.
You got it.
Right.
That's a key consideration for manufacturing businesses. Financing needs to be flexible enough to allow for upgrades and replacements as technology advances.
So things like short-term leases, technology refresh programs, even those vendor financing options that are specifically designed for the equipment's life cycle, those are the types of things manufacturers should be looking for.
Exactly. They need a financing partner who understands the rapid pace of change in their industry. Now, on the flip side, think about the construction industry. They're dealing with massive, heavy-duty equipment. That's a whole different ballgame.
Right. Those bulldozers, excavators, cranes, they're huge investments. And the construction industry itself can be unpredictable. Projects get delayed, budgets get cut. Financing needs to be able to roll with those punches.
You're absolutely right. Construction equipment financing often involves larger loan amounts and longer repayment terms because the equipment itself is so expensive and durable. Lenders who specialize in this area understand the cyclical nature of the industry and can offer solutions that work for those unique needs.
So if you're a construction company, finding a lender who speaks your language is crucial.
It makes all the difference. And the same goes for other industries like transportation, healthcare, retail. Each sector has its own nuances, its own equipment needs, and its own set of challenges.
So it's not enough to just understand the basics of equipment financing. You really need to understand how it applies to your specific industry.
You hit the nail on the head. And the good news is there are lenders out there who specialize in those different sectors. They know the ins and outs of the industry, the types of equipment that are commonly used, and they can tailor financing solutions accordingly.
So finding the right lender is just as important as finding the right financing option.
Absolutely. It's like finding the right business partner. You want someone who gets your business, your goals, and your challenges, and who can work with you to find the best solution.
Well said. Now, we've talked a lot about established businesses, but what about those businesses that don't quite fit the mold? What about startups with limited credit history or businesses considered high risk? Do they have any options when it comes to financing equipment?
They do. There's a whole world of alternative financing out there for businesses that don't meet the traditional lending criteria. Let's
Right.
start with startups, since they often face the biggest hurdles.
I can imagine. They're brand new, haven't had time to build up their credit, and might be seen as riskier by some lenders.
Exactly. But there are lenders who are specifically looking to support startups, especially those with a solid business plan, a strong team, and a promising product or service.
So it's not impossible for startups to secure financing, but they might have to work a bit harder and explore some less conventional options.
You got it. One option is crowdfunding. Platforms like Kickstarter and Indiegogo have become really popular for startups looking to raise capital. You pitch your business idea and equipment needs to a large audience, and people can contribute money in exchange for rewards or even equity in your company.
It's like pre-selling your product or service to fund the equipment you need to create it.
Exactly. And it can be a fantastic way to generate buzz for your business and build a community of supporters right from the start.
But it can be challenging to raise enough money through crowdfunding, especially for expensive equipment.
It can be, especially if you're in a niche market or your product doesn't have mass appeal. But it's definitely worth considering, especially if you're passionate about your idea and can put together a really compelling campaign.
And what about angel investors? They often invest in early-stage companies that have high growth potential. Could they be a source of funding for equipment?
They absolutely can. Angel investors are individuals often with entrepreneurial experience themselves who invest their own money in startups they believe in. And they can bring more to the table than just money. They often offer valuable mentorship and guidance.
So it's not just a financial transaction. They're actively involved in helping the business succeed.
Exactly. But keep in mind that securing funding from angel investors is competitive. You need a strong pitch, a solid business plan, and a team they believe in.
It's like Shark Tank, but in real life.
Right. You've got to convince them you're worth their investment. And then there's venture capital, which is another possibility for high-growth startups, especially in tech.
I've heard venture capitalists are looking for companies that can disrupt industries or scale up really quickly. They're not afraid of risk, but they expect a big return on their investment, right?
Exactly. They're swinging for the fences, and they usually invest larger amounts than angel investors, often in multiple rounds of funding.
So it's a different level of investment with higher stakes
Yeah.
and higher potential rewards. But that also means a lot more scrutiny, right?
Absolutely. Getting venture capital is tough. You need a truly innovative idea, a massive market opportunity, and a team that can execute at a very high level.
So definitely not for the faint of heart.
You said it. But for startups that fit the bill, venture capital can be a game changer. It can provide the resources to scale quickly, build their team, and achieve their goals.
Okay, so we've covered crowdfunding, angel investors, venture capital. Those are all equity-based financing, right? What about debt-based options for startups that don't want to give up ownership of their company?
There are definitely options there too. Microloans are a great starting point. These are smaller loans, typically under $50,000, offered by nonprofits or community lenders who are specifically focused on helping small businesses, including startups.
So it's more about supporting those businesses than just making a profit.
Exactly. And their lending criteria are often more flexible than traditional banks, which can be a real lifeline for startups that are still building their credit.
Now, you mentioned SBA loans earlier when we were talking about established businesses. Are those also available to startups?
Yes. The SBA has programs specifically for startups like the microloan program and the 7A loan program. These come with lower interest rates and longer repayment terms, which can be a huge help for a new business.
So the SBA is definitely a resource worth checking out for startups looking to finance equipment.
Absolutely. And don't rule out those alternative lenders we talked about before, online lenders, peer-to-peer platforms. They're often more willing to work with startups than traditional banks. They might have higher interest rates, but their approval processes are typically faster, and they're often more flexible with their lending criteria.
So there are definitely options for startups, even if they don't have perfect credit or long history. But what about businesses that are considered high risk? Maybe they're in a volatile industry or they've hit some bumps in the road financially. What are their financing options?
There are options for them too. It might be harder to get financing and they might have to pay higher interest rates, but there are lenders out there willing to work with them. One option is to look for a lender who specializes in higher risk businesses.
So it's like finding a niche lender who understands the specific challenges of that industry or situation.
Exactly. These lenders often have more experience working with businesses that have less than perfect credit or are in industries that are considered riskier. They're willing to take on more risk, but they'll typically charge higher interest rates to compensate for that.
It's a trade-off. You're paying a premium for access to capital, but it might be your only option.
That's right. And you have to carefully consider those costs and make sure they fit within your budget. Another option is to provide additional collateral.
So if you're willing to put more on the line, lenders might be more willing to take a chance.
Exactly. Offering a personal guarantee or using other assets as collateral can lower the lender's risk, which makes them more comfortable approving the loan.
But that also increases your risk. If you can't repay the loan, you could lose those assets.
That's true. It's a balancing act. You're weighing the need for financing against the possible consequences of default. It's a decision that should never be taken lightly.
Okay, so we've talked about traditional and alternative lenders and even considered specific industries. There's one more piece of the puzzle. I want to discuss the tax implications of equipment financing. I'm guessing there are some deductions and write-offs that could help small businesses save money.
You're absolutely right. Taxes are a crucial part of the equation. Understanding how different financing methods impact your taxes can save you a lot of money in the long run. Let's start with a common one, interest expense.
Interest expense. So the interest I pay on my equipment loan or lease is tax deductible.
In most cases, yes. This applies to both secured and unsecured loans used for business purposes, as well as a portion of lease payments. However, there are some important details to keep in mind.
What kind of details?
For example, the equipment has to be used primarily for business purposes to qualify for the deduction. And if you're leasing, the part of your payment that's considered interest versus principal can change based on how the lease is structured. It's always best to talk to a tax professional to make sure you're deducting the right amount.
So deducting interest can definitely save you money, but it's not as simple as just writing off the entire payment. There are specific rules involved.
Exactly. Another significant tax benefit is depreciation.
Depreciation.
Mm.
I vaguely remember that term from accounting class, but I never fully grasped it. Can you refresh my memory?
Of course. It's the idea that assets lose value over time due to wear and tear, obsolescence, things like that. The IRS allows businesses to deduct a portion of that lost value each year as an expense, which lowers your taxable income.
So instead of deducting the entire purchase price all at once, you're spreading it out over the useful life of the equipment.
That's right. And there are different ways to calculate depreciation, plus specific rules about how long certain types of equipment should be depreciated.
Sounds complicated.
It can be. That's why it's so important to have a good tax professional on your side. They can help you choose the depreciation method that works best for you and make sure you're taking all the deductions you're entitled to.
So depreciation can be a big plus for businesses that own their equipment, but it's not just a free pass to write off the entire purchase price up front.
Exactly. And always keep detailed records of your equipment purchases and depreciation schedules for your tax filings. Now, let's shift gears and talk about Section 179. Have you heard of that?
Section 179, it rings a bell, but I'm not sure I know what it is.
Section 179 of the Internal Revenue Code gives small businesses a great incentive to invest in new equipment. It lets you deduct the full purchase price of qualifying equipment in the year you buy it and put it into service, rather than taking the deduction over several years through depreciation.
So it's like an immediate write-off for the entire cost of the equipment.
Basically, yes. This can significantly reduce your taxes the year you buy the equipment, which can be a real boost for your cash flow.
That sounds amazing. But there have to be some limitations, right?
There are. For 2023, there's a deduction limit of $1,160,000 and a spending cap of $2,890,000. As long as your total equipment purchases for the year stay under that cap, you can deduct the full cost of qualifying equipment up to the deduction limit.
So there are limits, but they're pretty generous. Section 179 sounds like it could be a game changer for small businesses.
It really can be. But it's important to understand the rules and make sure the equipment you're buying qualifies for the deduction. And as always, talking to a tax professional is a good idea.
Great advice. The tax side of equipment financing seems pretty complex. There are a lot of things to consider, lots of rules to follow, but also a lot of potential savings if you know what you're doing.
Exactly. It's not something to try to figure out on your own. A tax professional can help you navigate the complexities and make sure you're maximizing your deductions and minimizing your tax bill.
Okay, we've covered a lot of ground here. We've tackled different financing options, different lenders, and even tax implications. There's one more aspect I want to touch on, the human element.
You're right. We've focused a lot on the numbers and technical details, but at the end of the day, it's all about people.
Absolutely. It's easy to get caught up in the interest rates and repayment terms, but building strong relationships with your lenders, vendors, and even other business owners can be incredibly valuable.
Couldn't agree more. Take the time to connect with your lender, talk openly about your financial situation, and be proactive in addressing any concerns they might have.
It's like any other relationship. Communication is key.
Absolutely. Don't be afraid to ask questions. If something in a loan agreement or lease contract is confusing, ask for clarification. Lenders should be happy to explain things in plain English.
And if they're not, that might be a sign to look for a different lender.
I'd agree with that. Remember, you're not just a customer to these lenders, you're a potential partner. They want to see you succeed because your success is ultimately their success.
It's a win-win situation.
Exactly. When you approach equipment financing with that mindset, it can make the whole process feel more collaborative and less like a cold transaction.